You're listening to Seattle Real Estate Podcast.
Hey everybody, I'm Sean Reynolds, the owner of Several Properties Northwest, Reynolds and Kline Appraisal, and your host of the Seattle Real Estate Podcast. What we're talking about today is mortgage delinquencies are at record highs. They are at levels that we have not seen since 1999. People are behind on their mortgages at a level that it's been literally over 20 years. It's 21 years since we've had this. Are these numbers artificially inflated? I mean, not really, but what you've got is this article that I'm going to read from describes it as a pig in a python effect, meaning when you shut the economy down and all these people lose their jobs at the beginning, you're going to have these long-term ripple effects, and it's the python ate the pig, and now it's kind of going through the python. So here we are. It's not going to get better. It's going to get worse for a little bit, and that is why our Stimulus 2.0 package is so critical for a big segment of the American population, because they've been out of their jobs, they're behind on their mortgages, they need some help. Will a stimulus package solve all this for them? No, but it'll certainly help, and it's a point in the right direction before people can figure out new job, whatever it's going to take to get back on their feet, because so many people have been impacted by this. The unemployment rate is literally double now what it was before the coronavirus shutdown happened, before the recession that we're experiencing right now happened. We are recovering, but this is one of those impacts that's going to take a while to work its way through, and that is record high levels of mortgage delinquencies. People behind on their mortgages. Let's jump on in. So this is from Yahoo Money. Mortgage delinquencies rate hits 21-year high. It's from Dara Singh. She's a reporter with Yahoo Finance. The share of homeowners 4 months behind on their mortgage payments hit a 21-year high in July. That's according to latest figures from CoreLogic, a financial data and an analytics firm. The 120-day delinquency rate stood at 1.4%, up from 0.12 in July 2019, and the highest level since CoreLogic started tracking delinquencies in 1999. The rate includes those homeowners who declared forbearance as a result of the CARES Act. So this is lumping together everybody, anybody, even if they've done the forbearance, which is you're working with your lender, maybe you're not going to pay your mortgage for 6 months, tag that on to the end of your mortgage, but you don't change the terms of your mortgage, just basically add it on. And it's a way to get through a time period where you don't have any income or whatever, and you need to get to that next step without having a lump sum payment come due. I know a lot of people thought, okay, if I take a mortgage forbearance for 3 months, at the end of the fourth month, I'm going to have to pay everything back. And some lenders were trying to get people to do that initially, but a lot of that has been worked out since. And I think solutions have been created, but people who are on mortgage forbearance, those are also included with these numbers. There are people who are behind on their mortgages. So what we're seeing is a pig in a python effect, with a spike in June for 90-day delinquencies, and now in July with 120-day delinquencies, said Frank Nothaft. He's the chief economist at CoreLogic. The pig in the python is just python ate the pig, pig's going through the python. So at 90 days, same thing. Pig hasn't gone anywhere, still inside the python, moving through. This is what we have to deal with. And guess what? After 120 days, it's going to be the same next month. You're going to be like, oh, there's still a really high level of people unable to meet their mortgage obligations. And that's what we've got going on. And that's why I think that second round of the stimulus package is so critical for a big swath of the American population, because these are people out of work, having a tough time meeting their obligations. We don't want a massive rise in homelessness. We want to keep people in their homes, and Stimulus Package 2.0 will go towards helping that impact of people behind on their mortgages. Getting back to the article, I think it's a big concern, especially as the CARES Act provided forbearance, but homeowners will still have to owe every payment. So it's not like when you're going into forbearance, it's not like that payment goes away. It gets added onto, gets basically tacked on typically to the end of your term. So people still owe that money. It's just not free money. All right, we will see 2 million loans seriously delinquent in 2021. 2 million. That's a lot of loans. The report's other findings also demonstrate the severity of the cash crunch. The rate of those at least 90 days past due jumped to 4.1%, up from 1.3% in the same month last year. So call it a little over 3 times as much. And the highest level since April 2014. Those are at least 90 days past due. All 50 states experienced an uptick in seriously delinquent mortgages, those characterized by payments 90 days or more late. But some bore the brunt more than others. In New York, that rate climbed to 10% in July, up from 4.3% the year before. New Jersey's rate hit 9.6, up from 4.5. So we're basically talking about at least double the rate from a year prior of the 90-day past due mortgages. Typically double. This year, it's double. The rate is double. New Jersey's rate hit 9.6%, up from 4.5%, while the delinquency rate in Florida increased to 8.6% from 4.1% in July of last year. If there continues to be financial stress, we can see at least 2 million loans seriously delinquent by the end of 2021, 𝒄𝒕𝒍 said. Additional fiscal stimulus will likely be needed. I don't think it's likely, it is needed. Now, you might argue on what you put that into, but get the people some money is the bottom line. That's the bottom line. I don't think anybody disagrees on that. I know Trump had a tweet that, hey, I'll sign a $1,200 per American citizen right now. Just you guys need to get this squared away. And there's all this wrangling going on between the White House, House of Representatives, and the Senate there. And I don't think you're going to see a package get put together before the election happens. Maybe right after the election. I think that's wishful thinking too. But I think the sides are too far apart right now. They haven't even figured out the major general broad terms, because then after they've got that kind of squared away, it takes a long time to iron out all those details. I mean, they've got a team of people from both sides who get together and just basically grind out these details. Would not want to be involved with that. It's just a bunch of back and forth, and everything's so politicized right now that either side gives a little bit of something. They're not doing that. They are both the House and the Senate and the White House. They're all just going for the throat. They want to win. That's bottom line. All right. As the next round of stimulus talks remain unresolved between Democrats and the White House, including additional unemployment benefits and direct payments, many Americans will be forced to stretch their dollars as far as they can, and they already are, and they already have, because the CARES Act, that money is long ago spent. That is in the rear mirror way back there. That money just done, gone. We need a stimulus package 2.0, and we need it quicker than later. Those who have chosen forbearance offered by government-backed mortgage guarantors still face the prospect of paying back months of past due mortgage payments when the forgiveness period ends. While elevated savings may help thousands meet their payment obligations in the near term, additional fiscal stimulus will likely be needed to help households to bridge the gap until the labor market fully recovers, said Ray Thomas, senior economist at Wilmington Trust, a financial firm. This whack, the way the whole coronavirus thing went down was so jarring to the economy and has had so many ripple effects that I think it's just going to take, and I don't think anybody disagrees, it's going to take a long time to work this out. And what is crazy is that how the economy was doing before this all went down. It was humming along. The economy was amazing. And then, boom, it just got sidetracked. Millions of people unemployed. I know we recently had a little bit of a jump in the unemployment number that we weren't exactly expecting, but I think you're going to see that kind of thing more. I mean, it's just going to happen. I think there were close to 900,000 unemployment. The unemployment numbers were close to 900,000. They were supposed to be like closer to 825, something along those lines. I'm off with those numbers, but it was like, oh, that's not good. But when you've got all this stuff going on, nobody can kind of be exact about what's going to happen. And I think we need that stimulus package more so than a lot of people, and probably more so than a lot of you viewers and listeners out there think, because my demographic, people tuning into this podcast, are typically a little bit older. They are middle age, and they are not on the front lines. They have not lost their jobs. And those are the demographics, the much younger demographic, that entry-level job position. Those are the people that have lost their jobs. And the next step up are people who are, kind of working their way into their careers and have bought a house. Those are the people that are most vulnerable, because those are the people that lost their jobs as well. And they happen to be homeowners. And guess what? They are having a difficult time with this whole thing, getting another job, whatever. When the coronavirus first hit, we had to shut things down. I spent literally about a week, I think it was like four or 5 days, kind of trying to hold deals together that blew up because people lost their jobs. People were scared to sell their homes. People were scared to buy homes. Nobody knew what was going on. And then we went into the lockdown, and basically nothing happened there for like a month, even though real estate was deemed essential, both on the appraisal end of things and on the real estate sales end of things. We were deemed essential, but if nobody's going out looking at homes, guess what? And I can't blame people. I'm actually surprised that this market is as hot as it is. Seattle's just had some staggering numbers as far as appreciation goes. Everybody thought at the beginning of the coronavirus, all markets are going to drop. We're going to have record levels of short sales. We're going to have record levels of foreclosure. And guess what? Because of interest rates and the lack of inventory that was on the market, now we've got even less inventory on the market. And you've got the Fed basically committing to low interest rates through 2022. Sometime in 2022, you've got this low interest rate environment. Things have just been screaming in residential real estate, just humming along, and Seattle's no exception. So many of the other markets are out there. But for so many people that lost their jobs, we need a stimulus package, and they need it sooner than later. A lot of what I deal with is people who are in the Seattle tech world, and guess what? Those are not people who have lost their jobs. They're able to work from home. They are a little bit higher up the totem pole of employment hierarchy. That's just what you deal with in real estate. Certainly you deal with first-time home buyers, and those were the people that basically I spent almost a week dealing with, just from a logistics standpoint of how can we help you hold this deal together. And so often it was, I lost my job, or the lender isn't going to give me a financing commitment because my hours moving forward, I'm an Uber driver, I'm a driver for Lyft, my hours moving forward, who knows what is going to happen there? And I can't really blame lenders for wanting to say, yep, not making this loan, not doing this loan. What did piss me off, though, was when a borrower of ours would lose their job, not be able to get their loan, and the seller would want to keep their earnest money. Nice way of kicking a person down. Hey, I know you just lost your job, but you're basically outside a contract, and we have the legal right to keep your earnest money. I know it's not a lot of money, it's $2,000, but because we legally can, that's what we're going to do. Saw a bunch of that, and it was not cool. If I was on the other end, if I was representing a seller, not a buyer, I'm basically talking about buyers. That's what we had for the most part, was a string of buyers that weren't able to get financing at the onset of the coronavirus. If I was representing sellers, I would give back those earnest monies all day long, because guess what? It's not the buyer's fault that the coronavirus hit and they lost their job. In that circumstance, I'm kind of like, what's fair here? Give them back their money. Give them back their earnest money. Give them back their good faith. They acted in good faith. The coronavirus came along. Guess what? None of us saw that coming. Make people whole. That's kind of what I do. But there's a number of brokerages out there who shall remain unnamed. They're big brokerages. They're big Seattle-based brokerages. How about that for a hint? Who did some things that, to me, not cool. I wasn't okay with. That'll stay with me forever. And little goes a long way. So let's finish this article out. A more robust recovery in jobs is also needed to help American homeowners stay afloat. The unemployment rate remains elevated at 7.9%, with weekly jobless claims still coming in at high levels. And that is true. Unemployment levels, the news story I continually see is that we've got these stubbornly, highly elevated unemployment numbers. They're staying up here. We want them down here. And for those of you in the podcast, my hand up here is staying up high. My hand down here, where we need it, is down low. And so from that standpoint, we've got elevated unemployment numbers, but I think you're going to see that for a while because this was so unexpected and rocked the economic boat so hard that we're just going to have to deal with it for a while. So the unemployment levels are only about half of pre-COVID levels. Employment levels are only about half of pre-COVID levels, Thomas said. So a further recovery in jobs and incomes will help households in meeting payment obligations. Very, very true. But in the meantime, until we can kind of get some of those jobs back, get that back in the rotation, a little bit of money in the American people's pockets is not a bad thing. Will it solve the record high number of people with mortgage delinquencies? Absolutely not. It just won't, because that's going to go on for a while, because a lot of these people are not going to, if you got 2 million people who are behind on their mortgages, guess what? That is not going to turn around overnight. And there's been so many people that have predicted a massive looming foreclosure and eviction process. And that's what we're trying to avoid. I think at some point in time, you will see that addressed. It just doesn't seem like it is any time in the immediate future. As, like I said, our political system just can't seem to figure out how to get that done in the face of this election that's coming up. All eyes are focused on this election and this other stuff, even though the American people need it. Not happening. I don't see it happening. I don't see anything dramatic happening before the election, and that's just kind of where it's at. So if you are out there, if you don't have a job, hang in there. I think help will come. It's going to be a while, and my words probably are sounding pretty empty, but there are a lot of programs out there that you can reach out to for help. Mortgage forbearance being the major number one. If you are behind on your mortgage and you haven't done so yet, reach out to your lender. Don't be afraid to pick up the phone when they call, because they are not going to bite your head off. They're going to try and work with you. So if you're behind on your mortgage, reach out to your lender, pick up the phone when they call, because you're probably looking at your cell phone when they call and go, oh man, it's just a constant reminder that you're behind on your mortgage. Work with your lender, see what kind of plan you can work out. That's what they're doing right now. Most lenders learned from the Great Recession, started in 2007, 2008, and they learned that it is far more cost efficient to work with the borrower than it is to foreclose on them. So hang in there if you're behind. That's the advice that I have right now. I know it's not great, and I know there's a lot of people suffering, and for that, it's a really difficult scenario. And even if you're in a position where you're like, I just don't know that many people, is this really true? Yeah, it is true, because the numbers are saying that, and there are just certain swaths of the population. Here in Seattle, I don't see a ton of it, but I also work in housing, and not a lot of first-time home buyers. I don't work with a lot of first-time home buyers. We work with some, but we're kind of just a little bit outside of that scope. So I don't personally experience it, but I know it's out there and I hear about it all the time. So that's where I'm at. That's it for me. So again, I am Sean Reynolds, the owner of Summer Properties and Reynolds Kline Appraisal. Thank you for tuning in to this episode of the Seattle Real Estate Podcast. I will catch you on the next one. Thanks again for tuning in. Bye. Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.